the markets had priced that in. What it was when they came out, they raised expectations for the next few hikes. And that's what shocked the market. So it's almost like a stock reporting earnings, right? So the earnings came out in line, but the Fed raised guidance on interest rates. And that's really what kickstarted the selling pressure, because then the dollar took off. Look at the 10-year yield. I mean, the 10-year yield is above 3.7% now. The 2-year is well above 4. I think it kissed 4.2%. That's an incredible inversion and a very scary thing. And one thing that I think, and again, it blows my mind, the Fed's not kind of talking about this, or maybe not aware, but when you go back to Volcker back in the 80s, he kind of had this stutter step where he raised from 12% to I think about 18%. That's about a 50% hike in interest rates at the time. Now, think about the difference in interest rate hike percentage-wise from where we were until where we are now. We were basically at 0, and now the Fed has us what, at 3.25? I mean, percentage-wise, this is an enormous hike, way more than Volcker back then. And it's going to have a major impact on the economy. And again, this is what scares me about things is like, it's one thing to say, oh, if we go into recession, the Fed can save the day by coming in and, doing what they've done. But if you have inflation that's sticky around 4 to 5%, which is what I think it's going to be, how do you get us out of it? And are we going to be in a long-term bear market? And again, there's this kind of, it makes me think that the Fed is trying to reestablish credibility, but it's almost like they're doing it in the wrong way, right? They're not doing this measured, methodical approach. They're just saying, you know what, we got to punish the market because you guys expected us to be lenient forever. Now we're going to really kick your butt and show you that we're not. And I think that's really dangerous. So I think the key is this, and this isn't being talked about very much in the media, but it's really worth noting, is that the last 2 nights, Japan has intervened in their currency markets to prop up the yen. And what they're doing to prop it up is selling US bonds, right? They're dumping bonds on the open market. But when you sell bonds, what happens to interest rates? It pushes interest rates up even more. So not only do you have a Fed that's saying, hey, we're going to keep raising rates, even after this last 75 basis point hike, we're upping our guidance by year end over 4%. But now you have other countries saying, hey, listen, our currencies are getting crushed. It's hurting us. We need to now prop these up. We're going to intervene and then actually add to the kind of the pain that we're seeing on the interest rate front. So it is a wacky situation. And it reminds me of almost going back to 2008, where things started to break, right? Where we started to have the derivatives market and all of these different things start to break down. And again, if the Fed is watching, be really careful here. But what's not easing right now, and I think this is why the Fed is being so hard-nosed, is that the labor market is still demanding higher wages. And wages, again, and this is something that I've talked about before, is that when a company has to double the salary for an employee, they can't just double the price they're charging for a widget, right? So what they do is they'll raise the widget by 10% this year, next year 10%, 10%, 10%. And they make up for it over time, getting their margins back in line. And I think that's the key, is why it's going to be remaining sticky on the inflation side. The input costs are coming down. Those will come down, but you have that wage issue that is still sticky. Yeah, so I do think that the labor market will start to weaken, right? I mean, it's just the nature of it. Almost every single day, and I pay attention to the stock market and the news. Yeah. There's a new company that says, hey, we're going to lay off 10% of our workforce. We're going to cut X amount of spending, and all of those will loosen up the labor market a little bit. But I think the key is that it doesn't negate the shock that we already saw, where people at McDonald's or people at these different places are now getting, double what they were getting, $25 an hour or so in salary. Now, you're not going to see those salaries go back down. They may not continue up, but they're not going to go back down. And so you have these businesses that have to figure out a way over the next few years to kind of come back in line with the margins that they had before. And that's where you get this kind of stickier inflation that doesn't get down to this 2% or sub 2% mandate. And I think even the Fed in the statement, they said they don't expect inflation to come down to 2% until 2025. Yeah. A price of an apple is still up 50% from where it is. And so you can't just see wages all of a sudden go back to where they were. So I do think where we are in wages is what people get used to. people do not take well to wage cuts. And so I think you're going to see wages stick at these levels for the longer term. Now, they're not going to rise really, but at the same time, they're going to stick here. And again, that's going to be something that these businesses will have to pass through over time. And then they're not able to get us out. And you could just look at stocks or markets like the Chinese stock market, which went from 2003 to 2008. It had this monstrous run, much like we saw over the past 5 years or so. And then since then, it's been in 10 years, actually 14 years of sideways chop. If you look at the Brazilian stock market, same thing, had a huge run in the early to mid 2000s. And then since then, those markets have just been up, down, not making new highs. And I think that's something that US investors are going to have to get used to. Now, as a swing trader, it's a good market. You get the swings intra move. As an investor, it's going to be a tough market. The Fed really pulled forward a lot of the upside, but it's going to then be the last leg of the marathon is going to be the toughest. So to me, it makes perfect sense. I mean, think about 2021 when money was free and the government was sending out checks to Americans nonstop. And so there was just so much liquidity and money in the system that a ton of it wound up in the stock market, buying tech stocks, these tech stocks that had no earnings, that were trading at crazy multiples to revenue numbers. And now you're seeing this kind of suction. It's almost like a vacuum sucking the liquidity and the money out of the system through higher interest rates, through quantitative tightening, QT, and that's going to just bring down these asset prices. And we've seen, I mean, amazingly, like a stock like Roku down from what, 500 to like $60, kind of, I mean, incredible type drops in these assets, but it makes a lot of sense since the money is getting sucked out. There's not as much money to go around to so many stocks now. The problem that's going to be, and the next leg down that takes us to 3,000 or sub 3,000 is a few months later, we're going to realize how bad the recession is. And then we're going to turn to that Federal Reserve and say, Jerome Powell, come save the day. And the Fed is going to say, can't do anything, guys. We have inflation that's too high. And that realization, I mean, think about the addiction of the markets over the last 20 years to this. The Fed always bails us out. I mean, in 2018, the Fed just threatened to basically raise rates. The S&P and the NASDAQ dropped 20%, and the Fed quickly reversed and started printing money again. And that's the market that we've been in, where the Fed is like the parents always protecting the child. Well, guess what? The child is out of the house now. It can't be protected anymore. And that's the thing that investors need to understand, is that every time you get a new candle on the daily chart, it's a new piece of a puzzle. And a good technician is going to go and look and say, okay, does this change my thesis? Does this change anything? And really what we've seen is the Fed's gotten more hawkish. The economic outlook for me is even more bearish based on the Fed being more hawkish, and that you have to start lowering asset prices even more. No, I think that's right. I think you want to look for a Fed pivot. The Fed pivot will be positive in the near term for risk assets, including Bitcoin. And I think that's where you start to nibble. I'd strongly encourage your friend to kind of not go all in at that level, but instead just dip a toe in the water. If it drops a little bit more, do another toe, kind of do that. Because again, we just don't know, remember, Bitcoin's only been around for now 13 years. It's a baby of an asset, and we just don't have enough data to really know for sure how it's going to behave.